Hey team, this is Norbert coming to you with my weekly mortgage rate update. But before I get into where interest rates landed for week ending February 2nd, I wanted to share this interesting chart with you. I feel like it has some great information for you to know and also some great information to share with some buyers. Take a look at this chart. It shows 82 years of average mortgage rates and average home appreciation rates, going back all the way to 1942. This is such a powerful illustration as to how much wealth real estate can create for an individual. In the past 82 years, there have been 74 years in which prices went up, only 7 that went down, and 1 where they remained flat. By the way, 5 out of the 7 years where prices declined happened during the Great Recession. I feel like we've heard so much noise in the past year from clients and their so-called expert friends about waiting until prices come down. Show them this chart. Historically, real estate is a winning investment, and they may have to wait a really long time, sometimes decades, to try to purchase in a down market. It really is powerful stuff. Now, let's get into rates. As far as the 30-year fixed conventional rate mortgage, week ending February 2nd, we were at 6.625 with a 1% discount paid by borrowers. That's an APR of 6.737. Same as last week. The 30-year fixed FHA rate is at 6% with buyers paying 1% in points, APR 6.859%. Of course, these are all based on perfect scenarios, which I define as someone buying their primary residence, single family, owner occupied with a 760 or higher FICO score, and a down payment of 20% for conventional loans and 3.5% for FHA loan products. Rates have been relatively flat over the past 2 weeks, and mortgage bonds have been trading in a choppy but sideways pattern. So we've really seen kind of rates plateau out maybe, but kind of stay the same over the past 2 weeks. As far as economic news this past week, it was Fed week. The Federal Reserve concluded their 2-day meeting on Wednesday, and as expected, they left the Fed funds rate unchanged. Fed President Jerome Powell said that he doesn't think it's likely that the committee will reach a level of confidence to cut rates at the next meeting, which is scheduled for March 20th. The markets didn't like these comments, and it got a little bit worse. Check it out, guys. Something to keep your eye on and your ears peeled for is quantitative tightening. Specifically, how will the Fed handle their quantitative tightening policy? A lot of times they call this QT. Listen for it in the news. I recommend Googling it, do a little bit of research, educate yourself, because this will probably be the biggest reason that mortgage rates improve this year. Get out there and get information. In other news this week, on Friday, we got the much anticipated jobs report that the Bureau of Labor and Statistics puts out. It showed 353,000 jobs were created for the month of January. This was much higher than the 180,000 expected by the markets. This number was based on seasonally adjusted math that the BLS uses. Unfortunately, mortgage rates in the market did not like where the jobs numbers came in at, and we lost about 41 basis points, which is an approximate increase of 1/8 in rate. Many economists that I follow think that these books are being cooked because the unadjusted or raw jobs numbers showed an actual loss of 2.6 million jobs, not a gain. It seems a little crazy to have such a huge disparity and a disconnect. It makes you wonder, what's going on here? Well, thank you for your time. Thank you for watching this video. If you want more market insights, hit the subscribe button and turn on the alert so you get more information about the market so you can educate yourself. I hope you enjoyed the video. Until next time, let's get better, let's close more deals, and I'll see you next week. Bye now.